Well, welcome everyone to our Equity, Compensation, and University Startups webinar. Thank you so much for joining us today. My name is Kirsten Loita, and I am a partner at Osage University Partners, leading our university relations efforts. Today, I'm going to be moderating our presentation on equity, compensation, and university startups, and we'll go to the next slide. So I'd like to introduce Manny Stockman and Nabil Ullah of OUP, who are going to be our presenters today, and I'm going to have them briefly introduce themselves. Manny, let's start off with you.
Sure. Thanks, everyone. Good to see so many familiar names in the audience today. I'm a partner at OUP. I've been here since around 2015. I focus on our tech practices, but just like all the investors on our team, we also work really closely with many of our universities. And here to give a talk with Nabil on something that we found to be really important and to our tech transfer offices and understanding founders' equity. So thanks, everyone, for joining.
Great. Nabil.
Hi, everyone. My name is Nabil Ullah. I am an investment analyst here at OUP. I've been here for about a year and a half now. I help support our investment team as well as various other functions across the firm, especially when it comes to heavy data analytics. And this was something I was able to help with recently. And we actually updated the presentation recently as well. So excited to talk to you about that.
Terrific. And Nabil also wrote a blog on this subject as well. He'll put the link to that in the chat. We're really thrilled and thankful that he did that as well. As many of you know who are at our partner institutions, if you have worked with our new Smart Sheets Dialogue program, he's also the brains and the brawn behind that program as well. So thanks so much for everything you do, Nabil. Yeah. We'll go to the next slide. So first, we have a few administrative items that we want to get into before the content of the webinar. The slides and recording of this webinar will be available on OUP's partner portal, which is available to the partner institutions that we work with, and it will also be available on our YouTube channel. And so please do go there afterwards. Send it along to anyone who maybe couldn't make it today, who did want to learn this information. We also encourage questions throughout this webinar. Please use the Q&A tool in this Zoom to submit your questions instead of the chat. That way I can order them better and ask them more easily to our panelists. We did receive a few questions ahead of time, and we will be answering those as well throughout this webinar. So we'll go on to the next slide. And this is just the quick agenda for this particular presentation. We'll talk about formation, equity at formation, dilution of equity, industry averages on founders' equity, how ownership looks like, cap tables and what that means, and then waterfalls, and then exits. And then we'll have time, hopefully, for Q&A. We will ask questions as they come in. They seem pertinent to what we're speaking about at that time, but we'll hold off any questions that come in that maybe need to be answered at the end. So I'll do my best to moderate that as we go along. So next slide. We do know that there are some of you who are not as familiar with OUP. So just a brief introduction to Osage University Partners. For those of you who do not know us, we are a venture fund that partners with academic institutions to invest in their startups, typically by exercising the participation rights available for the licenses of the partner institutions that we work with. As part of this partnership, the institutions share in our profits and receive programmatic support on technology transfer and academic startups, such as this webinar here. We're now in our third fund, having raised approximately $600 million across all three funds, and we've made over 125, I think at this point maybe 130 investments in all areas of deep sciences, which are exemplified by the companies, the portfolio companies noted on this particular slide. We're always happy to talk with people about our model, so please feel free to reach out to any of us if you'd like to learn more information. So with that, we'll go to the next slide. And I will pass the baton, I believe, to Nabil.
All right. Thanks, Kirsten. So this talk is structured in a couple different ways, including what are the right ways to distribute equity among founders, how to think about dilution, and then looking at some numbers to actually make sense of it all. But mainly what we want to go through here is how the economics of starting a company and succeeding or failing in a company can play in your favor. And whether you're a founder or an early employee, there's no doubt that one of the biggest incentives about being at a startup is the large potential upside. But that upside is also determined by your ownership and what happens to that ownership over time. So just to set the stage, we're going to start off with a few basic definitions meant to help you navigate conversations both with your co-founders and other VCs as you think about fundraising. When building a company and raising venture dollars, you're going to get a term sheet from an investor that wants to give you money in exchange for a percentage of your company. The items you see on this slide can help you identify and understand a little bit about what you see in that term sheet. But as venture investors, when we provide you with a term sheet, there's something called a pre-money valuation. This is what we think your company is worth today before you accept any outside capital. This is us assigning a value to everything you've built, all the hard work, the research, and the team building you've done. So let's say, for example, your company has a pre-money valuation of $10 million. That's just one piece of the equation that will help determine how much of your company the investor is buying. And the post-money valuation is usually equal to the pre-money valuation plus the capital we give you. So in our example, if you're worth $10 million and I give you $5 million, your post-money valuation is $15 million. Put more simply, these terms set the percentage of your company that we're going to buy. In this example, we're offering $5 million for approximately 33% of your company. So sometimes the post money is not always equal to this because of the impact of creating options pools. So that's something that you should just be aware of. Moving down along, when you hear things like fully diluted shares or fully diluted ownership, it's basically the total outstanding shares that exist, where generally, as a venture investor, we will buy something called preferred shares. And preferred shares are exactly that. They are preferred. They are better and more valuable because of the terms around them, which we'll go into a little bit more detail on in the next slide. Common shares, on the other hand, are usually held by founders or anyone else on the early cap tables or people that have exercised options. And this is in contrast to public companies where everything is common. So whether you've bought $10 million of Apple or even $1,000 of GameStop stock as a meme trader, those are all common shares. In a private startup, there are classes of shares that can have a variety of terms associated with them, and not even the preferred shares have to have the same terms. So I'll move on to the next slide here. So now we can dive a little bit deeper into the preferred stock side of things. We briefly mentioned special terms surrounding the shares, which make them what they are. And that's what VCs are buying. The terms that get applied to preferred shares are a function of whether investors are operating in a buyer's market or a seller's market. It's interesting because we give this talk throughout the year, and market conditions obviously change over time. So in recent versions of this presentation, a couple months ago, you might have seen us say that we were in a seller's market, where there's a ton of venture dollars out there and all the terms are negotiable. But with valuations starting to return to earth, you could say that we're beginning to normalize more to a buyer's market. And in a buyer's market, there are more flexible mechanisms for VCs to utilize to reduce or manage our risk in a fair way. So on this slide, we thought it would be good to highlight to you what we think about when we're offering terms. This all revolves around what we call the liquidation preference. And if it wasn't for liquidation preferences, the terms in a term sheet would be much more straightforward. So just getting into it, preferred shares have a different value than common shares because this liquidation preference exists. For example, we could put any one of these three categories in a term sheet for our preferred shares. And the first thing to understand about investors who are buying preferred shares is the concept of first capital in, first capital out. So if I'm giving you $5 million and your company gets acquired tomorrow, I would get my $5 million back. And depending on which of these terms we agree on, whatever is remaining may go to the founders, common shareholders, or get distributed to us, or we could choose to convert them to common shares. We can choose many different options that benefit us when we're writing you a term sheet, but when finalizing the actual investment, only one of these terms can really apply. So the participating preferred is when I take my investment out first, and I also get to participate in the upside. So I get to participate in the front end pullout and participate in whatever is left. And this is actually the most favorable venture term you can get. The key thing to consider when bringing in venture capital is that investors will get their money back first. And it only really becomes an issue when you get acquired for something on the order of what you've raised. So if you raise $5 million and get acquired for 7, the investors get their first 5 million back. And what happens with the remaining 2 depends on some of these terms. Capped basically just caps how much we can get back. And the 1x non-participating preferred is actually the standard terminology that investors are offering today. Basically, in this scenario, as an investor, I can choose to get my $5 million back, or I can convert to common on a fully diluted basis so that my return is actually governed by the same equation as yours, which is how much of the company do I own times the exit value. And just as a sidebar here, and it's not really worth diving into, but when you're multiple years into the company and you have non-participating preferred features in your agreement, there exists something called a zone of indifference, where there are values of acquisition where the investor actually won't care because their return will be the same no matter what. So I think
there's a quick question that came in. I can answer. Bert asked, what kinds of caps have you seen? He was curious if they're in that kind of 50 to 100x category. The range, the caps you sometimes have in term sheets and investment rounds actually are nowhere near that. These are usually in the range of when they're using them, not at 1x. Almost always they're at 1x, but they might be around 2 to 4x. And the reason why they're there is because you want to have investors, cap out what they can return in case it's better to convert to common, or in case you don't want to have them continue to maximize their payout, and you may actually want to have them in a situation where they're inclined to move to convert to common shares, and so that conversion multiple, cap multiple, is not nearly in that 50 to 100x range. It's usually pretty modest, 2 to 4x, but they're still not used very often. They may start to be used in the next couple of months and years. Go ahead, Nabil.
Thanks, Manny. So when it comes to fundraising, it's all about how much money to actually raise. You could raise $1 million every couple months, or you could raise $10 million to last you 18 months to 2 years, or even $100 million that might last you 5 years. But what you should really be thinking about is this simple equation, which is your dilution. If you haven't raised any capital and you and your colleague, that means you and your colleagues own 100% of the company, then when you take on venture capital, we are buying a portion of your company, and that amount that I'm buying is the dilution you will face. So in our previous example, that was the 33% that I had quoted. It's the reduced ownership that you will have after we own a portion of the company. And it's expressed as the money you are raising divided by the post-money valuation of the round. When you think about the capital you need to raise, it's a function of many different things, such as how much you need to pay your employees, what you need to buy, as well as some non-functional measure of time. All those things go into deciding how much to raise to create the most value inflection. Because when we give you $5 million, we don't want it to turn into 5 million. We want it to turn into $20 million. And the valuation that you can create at your next round is some function of the revenue that you've produced, the attractiveness and excitement of your product, the experience of your team, as well as the market that you're going after. And these are all very qualitative, non-financial things, but the valuation you generate governs your dilution. So like I said, you could raise $1 million every few months, but fundraising is pretty exhausting. And you can also raise 100 million and be set for 5 years. But the valuation you would get today is not what you would get in 18 months because you would have made progress in that time. So what you really want to optimize for is the basic understanding of enough money to show demonstrable progress and create value inflection so that the next time you raise money, it's less dilutive. Generally in VC, every 18 months to 2 years is a pretty good cadence for you to go back to the street to start raising money again. So how do you as a company, as a set of founders, decide how much you should own in the startup you're about to form? When you're thinking about equity at any level, for your co-founding team, early executives, for early engineers, What you want to do is try and simplify how you think about things and look at it in the framework of rewarding past performance and past contributions. Was the founding inventor a prominent researcher in their field for decades? Were they the lead author on their paper? Did they drive the idea for the startup? Those are all things that are really important to think about and reward. But possibly more important, and it's tough to put a real balance on this, but you want to incentivize future performance as well. Building a startup is a long and difficult journey and will require you to learn things that you wouldn't have learned if you stayed in the university space. So when you pause technology development and go after markets and commercial sales, you're going to be wearing a lot of different hats, and you'll want to incentivize your team to drive towards the goal. And so the simple way we think about it is reward for past performance and incentivize future performance. So because the founder split can be a difficult thing to picture, we like to try to put some numbers on a page to get your minds around what an initial equity structure should look like. In venture, we call that structure a cap table, and it's usually a list of names or entities and how much each group owns. When you're forming a company, nothing exists, and your cap table probably just has the founders and maybe an option pool on it. And an option pool, which is represented by the 20% you see here, is where you're going to pull from in order to incentivize employees to join your company, because it's possible you won't be able to pay them enough salary to do so. The key message here is really that nothing is more important to your company than being able to hire a great CEO leader, and sometimes that person can be worth a very large portion of the company to get them in early. The background of this person could range from business to very technical. They could be an MBA or a PhD, but this initial CEO is living and breathing all the other non-technical things that the company will be doing, and drives the whole process forward from product IP to team development to fundraising. So this is someone who's pedal to the metal at all times. And it's important to note that this person doesn't always exist at founding. And so this pie chart doesn't always apply. But we found that in many of the companies we invested in, whether it's 2 founders or 5, there does tend to be one standout spokesperson. And it's good to see that person get rewarded and incentivized for future performance, even if their past contributions have not been as significant. And the remaining 40% you see here is just meant to be distributed among co-founders, founding scientists, VPs of product, and things like that. All right, so this next slide really just speaks to the breadth and depth of the enhanced data set behind this analysis. There is no one-size-fits-all to companies, and we've invested in over 100 university spinouts and decided to look at all the cap tables of these companies at their founding to understand the variety of ways the pie can be sliced. And this is not necessarily what every company should do. You could say it's more of an example of what might make a good structure for a university spinout that we consider to be investable. So now, with about 4 times more data behind the story, we wanted to try to put some guidelines around what that right balance might actually be. So on this slide, we basically try to give you an example of equity percentages that each of the roles were receiving when the company was founded. And it's a bit difficult to do this because the founder count can vary so greatly, company to company. And you can't split the pie the same exact way for all of them. But we were able to extract some general guidelines from this, which we're going to discuss in an upcoming slide. But the main point we want to make here is that there's a decent amount of data behind this now, and we think that it can be representative of a quality cap table. And the other message is that every situation is different. So as I'd mentioned on the previous slide, we updated this analysis recently because it's been pretty well received, and we get a lot of questions, of course, but what's important is that it's spurred a conversation and it's got people thinking about it and talking about it. And that being said, we identified some new interesting tidbits in the data that we've laid out on this slide. And that first one is that founders, whether they are professors or grad students, are given asymmetric ownership over researchers and advisors and professors who may not have the ability or interest to join the company full-time. Oftentimes, there are a number of part-time faculty founders who join startups as founders, and may be able to give 5, 10, or 20% effort, but they can't do the 200% type effort that some of their founding counterparts might be able to give. It's just not possible given they're balancing their jobs in academia as well. And so that's something you should expect to see, that in some ways, the incentivization of future performance is more heavily weighted than past contributions. And when it comes down to it, investors are investing in the future of your company, and they respect the past, but something we look to make sure is that the people who are going to be driving the company forward are properly incentivized to do that. The other thing we noticed was that 10 of the 63 founding CEOs we assessed were previously professors or grad students. And so that really goes to show that some of the companies we invest in, not all, but some have found a way to bring in a non-academic leader. And that is something we find very relevant to the quality of a company. We also found that most often when the founding inventor was the CEO, it was a tech company. Life science is a different beast in and of itself, and we can answer questions on or defer you to our life science colleagues. But those companies end up being formed by venture funds and surrounded by high quality entrepreneurs right out of the gate. And it's sort of an entire topic on its own. And we also identified a variety of equity distributions amongst the sectors. And the universities have a stake in these companies. And so we found that in the data that sometimes life science companies award the university more equity than tech companies. It's not always the case, but generally it's what we've seen in our data. And the other thing we often get asked, because we talk about incentivizing future performance, is why shouldn't a faculty who has spent their life's work in this space, is preeminent in their field, who will bring candidates and recruiting to the company and industry relationships, be rewarded more? And the answer is that oftentimes they are. If they truly are of that caliber, there are many individuals in the founding teams who may or may not be full-time, and they receive an asymmetric founder stake. We don't know for sure how much time these individuals spent at the company, but they do get significant ownership. All right, so now we get into the real meat of the story, the slide everyone's been waiting for. So referring back to that box and whisker chart we showed previously, this table takes a more quantifiable approach to what equity by role might actually look like before any options dilution comes into play. And again, these are not meant to be the rule. These are simply guidelines you can use when you're thinking about equity. So the roles in the top half of the table are some of the early line items we would see on the cap table of a university spinout. We think the founding CEO, which isn't always a non-academic, it could be a professor or a grad student, should own around 30% of the company. And then when you have a few different founding inventors that are all pretty involved, those are in the 10 to 40% range. And it all depends on the number of founders involved. And I'll just mention again that you also have to think about your options pool. If there's a 20% options pool, like we had shown on the previous slide, then there's some dilution involved in these numbers. And one of the real takeaways here is that the part-time faculty founders who aren't going to be working full-time at a company, maybe they're just spending a few hours a week, they should not expect to have an equal portion of the cap table. We see this number float around 5% across many of the companies that we've invested in. And sometimes they do get more, as we discussed previously, but if we come across a cap table and we see someone with a large ownership and they're not contributing as much to a company, we do try to get to the bottom of it and understand what they are contributing. It's important to note that you can't really change equity after the fact, especially if you've already raised, say, your first venture round. So make sure you're having clear conversations at formation about what you and your co-founders' contributions will be. No startup is one size fits all, and the initial equity split should reflect that. And then we have the universities, who often get between 5 and 15%. And this really takes shape due to either early seed dollars into faculty research programs or other risk capital that they put out well before any other investors did. And a lot of these institutions build up these large venture centers, and they're helping the companies before they even realize they're asking for help. And on top of that, there are also regulations around the IP that you all generate and that the universities will patent. And we've seen all sorts of ranges, all the way up to 50% in some rare instances, where there's a huge effort by the university to develop a certain technology, all the way down to just a couple percent. But generally, the bounds were between 5 and 15. And so the last section of this table that you see at the bottom is really meant to show you what a cap table may look like after a few fundraises and options pool refreshes. This can give you an idea of what the impact of dilution over rounds can do to ownership, but theoretically, your company should also have a much higher valuation at this point in conjunction with that dilution. And one thing worth just pointing out is a lot of times university spinouts, they don't start with a professional CEO, and it's totally fine if one of the faculty founders steps up. But we found that a professional CEO comes in later at some point, and 5 to 10%, as shown here at this stage, is akin to about 30% pre-financing. And usually it ends up being worth it from what we've seen.
There's a few questions that came in, Nabil. I'll answer Brian's first, which I think you touched on. It was about for founding inventors, are you assuming that they're part of the operating team, or is it different for faculty founders who don't plan to leave their day job? I think you addressed the one that's about faculty and inventors who don't plan on leaving the day job at the university. But it's actually really interesting for faculty who do leave their day job. They take a sabbatical, then they take a leave of absence, and they're there for 2 years and 2.5 years, sometimes 3 years. And that's always been part of the plan, that they would be there for a while and then go back to the university. And do they deserve less, given that that's the known endpoint, that there's an endpoint where they'll move away from the university or move away from the company? And honestly, I think we usually treat them as full-time founders, full-time founding inventors, as if they're doing the kind of 100 to 200%. And we don't put them into that part-time faculty founder bucket. So that's a good question. Sometimes we see that be confusing. And then Nabil, Tony had a question on starting academic founders university split percentages before the option pools are added in.
Yeah,
I think that's a refined point of the data you may want to clarify.
yeah. So the scales of percentages you see in the top half of this table actually are pre-options pool for all of the companies that we evaluated. But obviously it's not totally specific to your question, and we would be happy to follow up with what that exact split looks like on a more accurate basis. Because if we were to average the numbers here, we would be taking averages of averages, and we could give you a more accurate answer if we look at it company by company.
But just to clarify, because I think you did it this way, Nabil, if Nabil and Kirsten started a company in our database and they each had 2 shares, so 2 for each of them, and then 1 for the university, the way Nabil did the math, it's 5 total shares and the university had 20%. And that's the numbers that he's citing here. So it's ignoring anything else in the cap table. It's just focusing on the founders, because we can parse out, given the cap tables we've seen, who has founders equity or common equity in the early seed stage.
Yeah, exactly. Thanks, Benny.
Yep. Another question.
Want to answer the other question about what we've seen as far as pre-option dilution for first employees?
Yeah, it's an interesting question. We didn't focus in on that data.
Right.
It's also hard to parse out because oftentimes they're given options, and it just made for a difficult layer of the analysis. And we don't tag those people, even though sometimes we have full information. So we don't have a good answer for you there. But on the bottom, you can kind of see some of the option awards or equity allotments that you would give to early hires, and maybe you can do the reverse dilution to look at that.
Yeah. And then Alice had a question about that some faculty are part-time for the company but are really engaged intimately. So where do you think that they lie on this table? And I think that talks about the nuances that just often happen with companies. Like, this is not a one-size-fits-all table here, but maybe you want to comment a little on that.
Yeah, I think it's really hard to define how, in some ways you're either full-time or you're not, because faculty, when they're not working full-time on a company, have so many other commitments that pop in and out. Oftentimes when that part-time faculty founder is someone that we think of, giving their 1 day a week to the company or less. Most often it's less. And so if it's really going to be around a full day, maybe a day and a half, it can kind of bump up above that 5%, but there's no hard and fast rules in my experience.
Okay. Yeah. Okay. And then we have another question from Donna about, have you seen universities not part of the founding team? So I think not part of the initial entity that was created, but perhaps they license IP later. I think that's what the question is, and how that may also be a part of, fit into this. I don't think we did an examination of that, but we do see that. It's not as common of the story. So,
yeah, we see it, and it's not a large enough N for us to really analyze what the right anti-dilutions are.
Yeah. Okay. Thanks.
Well, great. Feel free to keep the questions coming. This is awesome. I'll jump to the next slide. I think I'm taking over control here. Sometimes there's a little bit of a delay. Let's give it one more second. Okay. Oh, there we go. Okay. Well, so a couple of the questions that popped in were obviously around scientific founders, given the audience, and I'm assuming many of you are tech transfer professionals. You are hearing from faculty that they either think they deserve more equity in the company, or they're continuing to provide resources to the company, and they would like to be rewarded for that. And the reality is, in some ways, they should be. It just depends how much. But also, what the expectations are that we have of a scientific founder from a university is someone who contributes, obviously on a scientific and technical level in their part-time roles, if that's their goal. But there are professors who do spend 1 to 2 years and leave the university and are really true employees of the company. It's absolutely something that I've seen faculty members become very, gain a lot of experience in non-technical skill sets as they join a startup, and they're continually benefiting from the access they have to corporates and new talent at universities, as well as they're all brilliant people stretching out their business chops and learning a lot of the needs of a startup while they're there. But once they return to the university, it's hard for them to stay up to date with what's happening day to day at the startup, and therefore it's difficult for them to really contribute at the same level they once were. And so when professors and researchers return to the university, or never left the university for the startup, the things that you really are exceptional at providing for the companies is just continuous thought leadership on the science. Every startup needs to have a strong R&D pipeline, whether it's on the tech side or the life science side. They need to have another product in the mix. They need to kind of create that, especially for university spinouts, create that sense of leading state-of-the-art, cutting-edge technology. And so we're often seeing universities and work with their professors to set up engagements with startups to help continue to feed the funnel of technology, either through continual licensing or talent. There's also that talent part, which I've seen is the most important aspect of spinning out a company from a professor's lab, which is just creates a great new home for the next generation of entrepreneurial talent at startups, because there's no one who knows the technology better than the graduate students and postdocs that came from the professor's lab. And so we really do, at the portfolio companies we work with, see a above normal percentage of our new hires coming from the faculty members' labs that were involved in founding the company. The other part of it is that startups are okay at marketing. Universities are much better oftentimes at marketing than the startup. And so the professors have a different podium that they can use to raise the profile of the company. So through the university and entrepreneurship centers and tech transfer offices, we've seen a lot of our faculty members leverage their relationship with the university to put the startup on a kind of highlight, or engage with potential corporate customers. So the topic of equity allocation that Nabil was working through is something that is really important because Nabil touched on this. You can't change equity easily. If you haven't taken any venture dollars in or any angel money in, it's somewhat doable, but it's really, really a painful process. And I do always suggest to founders that they go work with a lawyer, make sure you have the right structure in your founders' equity shares. No one should be given full vested upfront founder shares. It should be vested in a schedule. And lawyers are really the right people to structure this. But when you do, think about the structure that Nabil presented of, rewarding for past performance and rewarding for past success and incentivizing future performance, you do have to realize that a lot of times that's going to lead to unequal equity distributions. Like, we don't think companies that have 3 or 4 founders should split their equity equally. Everyone's going to have different roles. Some are going to be part-time. If they're all full-time, some may just have different commitments in their life that will obviously lead to lower contributions in the long run. And so we really do think that equity allocation needs to be done well up front, because if it's not, it's hard to take back. And it can lead to a lack of equity for other employees that you may be bringing in. If you have a graduate student who decides he wants to go to industry after a year or two, and he's sitting on the cap table with a huge chunk of equity, you're going to look at that when you have to hire in his or her replacement into a CTO role or something like that. And so that is going to have to come out of an option pool, which dilutes all existing shareholders. And so those are some of the key things we think about. And when you do have a poor equity allocation, really the only solution is to recapitalize the company. And you can't really remove a shareholder very easily. And so it's something that investors don't like to do. We're always looking for a reason to get to know when we're evaluating a company. And if it's a bad equity cap table, it's just one other hurdle that we have to get over to consider investing in a company. So it's always something to think about early on. And, I love it when founders and tech transfer offices reach out to me to just talk about, does this look right? Like, I'm, a graduate student that's, just, leaving the lab with our professor. Does this seem like an equal split? And so it's always good to talk things out and learn from the paths traveled by others.
Manny, we do have a question on vesting. Are you going to be speaking to that a little bit, or should we ask that now?
No, I'm not going to be speaking to it. So okay. I can actually answer that.
Yeah. So the question is, what is the usual vesting period, and are there different vesting periods depending perhaps on your role? For example, a professor who is returning to the university after a year versus one who returns after a longer time, et cetera.
Yeah. So for founders, it's usually something like you have an initial allotment up front, and then the remainder is vested over 3 or 4 years, is what we often see. That's easy for full-time employees. And I think part of the question was for faculty members that may be going back to the university. Oftentimes I've seen like commitment levels be reasons, like it's not quite vested on just time. It's, showing continued contributions to the company. And so that's some of the things I've seen. And it's still kind of a vesting concept, let's say, over 4 years, but there are actual guidelines as to what they have to demonstrate to actually be, considered vested every year.
Okay. And then we also had a question on recapitalization. How do you actually go about a recapitalization? Is there a quick answer that you can run people through on how that works?
Yeah. Let's see. So I'm trying to think of it in 10 words or less.
Doesn't need to be that quick.
Right. No. So, basically, if Nabil and Kirsten own each 2 shares of a company, and I, as an investor, own another 2 shares, and Kirsten decides to leave the company, and the next investor wants to recap the company for whatever reason. What they're doing is saying your company is effectively worth 0. Your company is worth 0. Nabil's shares and my shares as a recent investor are worth nothing. So are Kirsten's. I'm going to invest a fresh $5 million into the company. I then own 100% of that company, basically. But then I'll give Nabil and the previous preferred investors shares, 2 shares each, basically. So you're basically wiping out everyone and then building them back up. And you wipe out everyone by bringing their value to zero. So it's not done easily,
Right.
because you can't just recreate shares and classes of shares. It can be pretty painful, and it's also prone to litigation, obviously.
And can recaps be done in the case of an M&A?
I haven't seen that. I don't know. I haven't seen enough M&As. I'm still early in my
Right.
career.
We haven't seen enough so sorry, we can't answer that one.
Yeah.
And how do you tell former investors that their equity is now worth nothing?
Get ready to find out. It's going to be happening a lot in the next several months. Nothing is an exaggeration. Everything is based on valuation, and so oftentimes think of it like a down round. A recap is a big down round. But the way you tell investors that their equity is worth nothing is when they're not willing to, when the company will be worth nothing if the new money doesn't come in, is the simplest way to think of it.
Okay.
The only way their equity can be worth nothing is if the company is going to go out of business unless this new investor can come in. And the only way that investor would come in is if the company gets dramatically recapped.
Okay, and can a university be affected by recaps? And how is this affected by anti-dilution protection? But first part of that.
Yeah, it's a good question. I think so. In general, my answer is that universities, own common stock most consistently, and they would be affected by a recapitalization, just as if they would be affected by an up round or a down round. And so, recapitalization is just you're restructuring all the shares of the company, and so the university would also end up having their shares go to zero in like real efforts to recapitalize a company because of a poor equity allocation or a parasitic founder, which I still haven't seen in my career. You're kind of restructuring things and you're trying to build people back up, and I imagine a university would be part of the groups that would be built back up. But this happens really rarely. Oftentimes investors are just walking away from the deals.
Right. Well, and Jackson actually had a question on this, is on the recap. Basically the original shareholders are still on the cap table, but just diluted.
Yeah, they're diluted. They can be converted to. Yeah,
right.
there's
That's
lots
how
of
the
different
university
mechanisms.
question. Right. Yeah.
Right.
So, okay, we have lots of questions coming on this.
Man, we should have. Which one should we do next, Kate?
The legal challenges at the time of recapitalization. I'm trying to stick to the recap questions. We still have some on the vesting too, but legal challenges at the time of recapitalization. Have we seen many of those? I'm sure they occur, but
I haven't seen.
I don't think we've seen that. So
most often when recapitalizations happen or big down rounds, or pay to plays, it's because the investors who were at the table or were involved in the company aren't willing to invest in that next round to get the company through a tough time. And so they are making a decision, and they know that pay to plays happen. They know that the company may be getting a down round. And so they're kind of accepting the fact that their stock will be diluted heavily. And so I haven't seen that type of litigation. I'm sure it's happened though.
Okay. So I think some of these other questions we can wait on. I think we can get through some more of the slides, but we do have a number of other questions that are more about vesting and the options, et cetera. So.
Okay. Well, I'll keep going.
Okay.
All right, there we go. I'd say this whole same concept, and we're running out of time, so I'm going to quickly just say that the same sort of bad equity allocations for founders can also happen when you take on investors, especially at the early days when you're surrounded by lots of different angel groups, especially around universities, or angel groups or angel investors or pre-seed investors who may just have different time horizons than the average institutional investor in university startups. And so think of it the same way. You want to make sure you're working with people you know and you understand, due diligence on your investors, make sure that they're aware of what they're getting into, just because, oftentimes the terms they can put in their in the term sheets and for the rounds will stay around for a long time. Nabil touched on participating preferred and other preferences that investors put into their startup investments. Think of anything you accept today as a founder will likely be desired by future investors. So they're not going to let an angel investor get better terms than a Series A or Series B investor. The Series A or Series B investor will want those terms as well. So we thought, for many of the universities in the audience, it's good to see how dilution happens. And Nabil touched on this when he talked about, your dilution is a function of the fundraise, the round that you're raising, and the pre-money valuation of the company. And so, we looked at just some average successful university startups. This is now dated by about 5 or 6 years. But the average university startup, as an example, raises $41 million across 4 rounds and exits for around $240 million. And, the way that you build your companies is by raising just enough capital so that you don't have to hit the street too quickly. You want to raise around 18 months of capital and have that capital create asymmetric gain on the valuation of the company. So in this example on the left, the founders of the company and the co-founders own around 60% of the company, and they raise $1 million on a $4 million pre. And the goal of raising that $1 million is to turn it into $5, $20, $15 million of value. In this case, it turns into around $6 million of value, which is fantastic. The next round is a $10 million valuation, a $5 million raise on a $10 million pre for their Series A, and that's 33% dilution. And literally the math is pretty simple. You take the equity you own, multiply it by 1 minus 33%, and that 33% turns into 20%, so on and so forth, until the end when the founders own around, in total, 24% of the company. And the universities would be similarly diluted to founders. The one difference being universities don't have option pool re-ups, where they often will, founders will continue to get equity over time in their companies, but that's not reflected here. The reality is, by the end of a successful company, investors own most of the company, and that's okay. It's the way that you kind of need to build your company so that you can actually have a valuable exit. The option pool that I described also is important because as a startup, we don't want you to take the capital from us as investors and pay, a few people a lot of money. But the reality of competing for great hires nowadays is that you're competing with Google. Google, as everyone knows, they make a ton of money on their search engines. They hire the best software engineers, some of the best engineers across all categories. And it's, creates something as simple as a search engine. But it lets them pay their engineers north of $200,000 to $500,000. And as a startup, we don't want you paying your employees that much. We prefer if you gave them a healthy salary and then reward them with options. Options are what you use. It's your tool as a startup founder to hire the best people because they're shares that will give them ownership in a company that hopefully will be worth, a couple $100 million to a couple $1 billion. And it's hard for founders. I've seen all sorts of founders that are realize that, and they know they have to be liberal with the options and shares they award their employees, but they need their team. And if you don't have a team, you're not going to get anything. I've never seen a startup grow, at least in the tech side, without a very large team. I'll pause there and look at any questions in the mix. Are there any recent questions that we should be answering?
There's a ton of questions, but I think we can get through and to answer them together. There's a bunch on valuation. So,
got it. Well, let's keep going. We're going to skip the slide here before. It's basically just a quick reminder that options go down. Your option pool goes down over time. Oftentimes, you're thinking of it as like a 15 to 20% option pool that you create at the start of the company. And then you're hiring employees, giving a couple percent out to your best employees, a 10% out to the kind of average engineer or operational hire. And by the time you get to your next round, that might be depleted down to around 2%, 1% available option pool to reward new employees. And so you need to increase it again at your next round, which dilutes your ownership. So every time you raise, you're likely increasing your option pool. And then sometimes when employees leave the company, some of them might be vested and they might just be sitting on your cap table, and you'll need to incentivize another new hire with a similar set of options.
And actually, there is a question on option pool, so I'll just ask that now: is can the option pool give flexibility on rewarding scientific founders and their contributions?
Yeah, yeah. I mean, oftentimes I see option grants to advisors of a company, part-time employees of a company. There's also different ways you can give equity to your advisors and employees, or different ways you can give equity to your advisors and your board members. So they do allow for you to continue to give ownership to part-time faculty as they continue to add value for the company. I'm going to skip this part, which is kind of more of the details of different types of options that you can give. But generally for employees, you're working with restricted stock units or ISOs. ISOs are the most common. Restricted stock units are something that you do really at the founding, but not afterwards. And I think this is a lesson Lou Burnham always liked to talk about. So he thought it was just really impactful mostly for faculty to hear. And it's, you can either have a big piece of a small pie or a small piece of a big pie. And ultimately you want to have a small piece of a big pie. And the only way to build that big pie is to hire a team, raise capital to bring on new money that can help you grow your team and build your business. And so that's just something to be thinking about. And in taking on capital from venture investors, you're giving away control. And that's part of what is the startup world about. The last thing I'll try and run through is an example that is interesting for many people to see if they haven't worked through cap table math before. And it's similar to the bar chart you saw earlier on a kind of simulated simulated set of fundraisers for a startup. In this case, we just wanted to go through a couple rounds and then two exit scenarios, so you can start to understand how venture ownership affects payouts. And in this case, we don't specifically call out university ownership positions, but you can look at the scenarios and think of yourselves in the bucket of founders, because that's the most similar category to the university's common equity. So in this scenario, on the left bar, we have a company that will be acquired for $250 million, and their first raise, their founding structure on the left is a 20% option pool and a 40% share of co-founders equity and 40% for kind of the lead founder and the CEO. They raise a $5 million round on a $10 million pre, and they have around 33% dilution. The next Series A round, they raise $15 million and on a $45 million pre, they're diluted. They've only raised $20 million or so by the time they're acquired for $250 million. And everyone's happy in this scenario. I mean, the company has been acquired for well above what they've raised from a venture capital perspective. And the payouts are typically based on just the percentage ownership of the company. There's a slight tweak in the math here that the Series A had a participating preferred, which is why the math isn't perfectly matched to the numbers. And it's just a way for the Series A investors to get a little more payout. So that's something you can go through in a detailed cap table that we can share after the call. But the next scenario I wanted to bring up is when the acquisition is not very, very good. It's a $25 million acquisition. They've raised around $20 million of venture capital. And in this scenario, it seems like there's around $5 million left for everyone to share, including the universities. It seems like there's enough for everyone to make a few $1 million. But the reality is, since the company raised $20 million and there's a participating preferred, the investors get their first $20 million or so off the top of that 25. And in fact, it's a little more than 20 million because the Series A investors had participating preferred. It's 21.7 million. So really, all that's left is around 2.5 million, 3.2 million for the co-founders to share. And this is something it was interesting to me when I first joined the venture world. It's a way for us to protect the investor risk that they're putting the capital on the table. And so, really it's something that, you can't work around unless you have a full common cap table, which only a few investors are supporting nowadays. I haven't seen it in, many deals. In the previous 2 years of a buyer's market, there were investors that we're offering to invest in common. And it's something I think will only happen less in the next couple of years as it turns to a buyer's market. Were there any questions on these exit scenarios?
No, not in these exit scenarios.
Okay. So, just your takeaways for equity ownership. You need to take on equity to work towards, getting to a large exit. There's very few companies that can organically grow and bootstrap themselves to be worth several hundreds of millions of dollars. It absolutely happens every so often. But the types of companies we invest in, the types of companies our universities are a part of spinning out, they are intensive capital companies, whether they're developing drugs and need to pay for clinical trials, or they're developing chips or quantum computers, or building a software company with a huge sales team. You really need capital to pay your employees and buy hardware and resources. And so it's something that I think a lot of faculty founders have a hard time realizing they're going to have to give up the majority of their company despite the fact that they made an incredible innovation that started the company. The things that you should be thinking about when you're speaking with your startups that are spinning out, and how you can kind of message to them what the ultimate prize is going to be affected by. It's the round by round dilution, it's the liquidation preferences, and it's a few nuances of those preferences around participating and non-participating preferred. But really the key things that drive how much money they'll have in their pocket and success is that round by round dilution. Really focus on minimizing dilution. And that doesn't always mean maximizing valuation, because you can also take a lower valuation, work with great investors, and increase your valuation for the next round more than it would if you were just working with the venture investors that gave you the highest valuation in the previous round. So it's something that we often think about for these companies. And it's not always about taking the largest amount you can raise. Sometimes it's better to take, instead of taking 100 million, maybe you take 20, turn it into $80 million of value. And then your next round, when you raise the next 80, you can turn it into much more. So it's a compounding effect that a lot of professors should work through the math on, or a lot of researchers and universities should work through the math on to understand the impact of dilution at various stages. The one thing I definitely should focus on, I touched on it a little bit, it's that weird terms in term sheets and investor documents rarely go away. So if I'm an investor and I offer a term sheet with participating preferred with a 7x cap, the next investor that comes in after me is going to want that too. And so you really have to be careful of those terms stacking. And I think every time we invest, we're doing the math of our expected payout. And whether I put your option pool creation into the pre or the post, or if I do a participating preferred, I'm doing the simulation to say, okay, if I invest in this round and another round happens after that and the company gets acquired for $600 million, what's my payout going to be? What's the return on this round of investment given that? And so a lot of times people focus in on what's the valuation for the round that they're being offered, and the math is much more nuanced than that. So I suggest to all of our founders to do it, and also tech transfer offices to think about it as well, because oftentimes they're looking at anti-dilution and different companies raise at different valuations given their sector. And so there's a lot of kind of industry averages we're happy to help you figure out to understand how you should structure your anti-dilution clauses. And that's it for the slides. It sounds like there's some Q&A
Great.
We can go through in the last couple of minutes.
There absolutely is. And I know some people are going to have to leave at the top of the hour. We do have another 15 minutes scheduled for questions. So thanks for those of you who can stick around, since we do have a few questions here. But I do want to mention that we're going to put in the chat a link to a survey. Please let us know what you thought of this presentation, and let us know suggestions for future webinars as well. We actually do plan on actually making this into more of a series about equity and financial structures for startup companies. So be on the lookout for those as well. So first I'm going to follow up, just because you were talking about dilution Manny, is there's a question about how often can the startup forecast dilution? How much stake would you put on there, and then how much stake would you put on the forecast for dilution?
It's very hard to forecast dilution, but there's some typical things that we can do. You can imagine, what I'd suggest is for the sector the startup is operating in, software or life science. There's industry averages that PitchBook has of average dollars raised per round and valuation of rounds. And you can kind of do the math to say for life science companies, their seed round is often like 2 million on an $8 million pre, and then the Series A might be 40 million on a 60 pre. And you can kind of work through that dilution math, but there's big error bars on all of that.
Okay, next up, I'm going to go back to some of the vesting questions. So there are different situations that happen with regards to employees. Perhaps the CEO is no longer there, or some of the tech founders stopped contributing. What happens with a typical vesting schedule then? And if they don't fully vest, what happens to those options?
Yeah, if they don't fully vest, the options go. They go back to the company. So if they're not vested, they go back to the company. Oftentimes, if you have a founder who has built a lot of loyalty in the company and has goodwill, there's things that the board will consider doing, like accelerating their vesting schedule as a sign of good faith and continued collaboration. Particularly for faculty members who we know have value when they go back to the university. So you can always accelerate vesting. For those employees who get fired, you would not accelerate vesting usually.
Okay, terrific. And that actually answered another one of our questions about potentially that acceleration of vesting. And then, let's say, so someone is terminated or leaves, what happens? How did just run quickly through, for those who don't know, what happens with the partial vesting?
With a partial vesting, if you're vested, yes, you may own 1,000 shares of the company. And when you are leaving the company, you have a certain period of time that you have those options. If you have options if it's founder's equity, it's founder's equity, and you're already seeing the common table. If it's options that you've been awarded as a long-term employee of the company and they've vested, you have a certain period of time to exercise those options. And so it might be 1,000 shares at 10 cents a share. So you have to give the company $100 to exercise your options, and then they're yours. They're common equity. And so if you don't do that, you can go through a process of selling. A lot of things that employees do if they don't have the capital, if they don't have the $100 to pay the company. And if they don't, it goes back to the company.
And someone else wrote in comments here about they recommend vesting typically based on performance and not based on time served. How often do you see that?
I usually see time served for full-time employees. And then I've seen creative milestones in place for people that are advisors basically to the company.
Okay, great. We have another question on university equity dilution. So how much is the university equity typically diluted at the end of different rounds and and by the time of IPO? And I think this is going to be very variable, but do we have an answer to that question?
Well, we gave through that. We went through that simulation of $40 million raised.
Yeah.
And in that scenario, there was 80% of founders' equity. Yeah. Just throw the universities into that bucket. That 80% by the end of that $40 million turned into 24%, if I remember correctly. And so it would be exactly proportional in the way we modeled it out for the university. So if the university started with 8%, let's say, it would turn into 2.4%, I think, if my math would be correct there. I don't know. Don't hold me to that. Okay. But the dilution happens similarly to all others.
Great. And then someone asked here about valuation versus dilution. Is there something you can speak to on that?
Nabil, you want to take that one? It was part of that equation he put up early on.
Okay.
All right. Well, could you repeat the question?
Talk about valuation and how that affects what effect that has on the company versus what dilution means for the investors and the company.
Right. Yeah. So we had that previous example where we talked about how your company might have a pre-money valuation of $10 million, and we're giving you $5 million. So that makes your post-money valuation $15 million. And that formula for dilution is how much you're raising, how much the company is raising. So how much we as investors are giving you divided by that post-money valuation. So in this example, it's 5 divided by 15, which is 33%. So we are paying $5 million for 33% of your company, which means your previous ownership is now 33% less than what it had been.
Yeah.
So that stacks on top of each other as you raise another fundraising round and another one. And that's why it's so important to pay attention to dilutive events.
Yeah.
All right. Someone asked about whether they can share these slides internally at the university or otherwise. Absolutely. I mean, this is a public presentation. This will be available. So feel free to share these slides. Another question had a question. Jackson had a question about, can you talk about the term full ratchet?
Yeah. There's a great podcast, by the way, called Full Ratchet. Yes. And full ratchet is a provision that historically, I haven't seen it in a term sheet in 7 years at OUP. We may start to see it happen again. Full ratchet is a term that is used by investors that is effectively our version of anti-dilution, but in the extreme. It's saying if I invest in your company at a $100 million valuation today, and the next round is a down round of any sort, I get that valuation. So I claw back, and my shares get kind of juiced up with the value as if I invested at a lower valuation at a later time.
Great. So someone asked a question about how academics and other founders should start anticipating the issues with regards to founders' equity while still at the pre-startup phase, before they start the venture. What should they be thinking about? Who should they be talking to?
Yeah, I think it's really an incredible ecosystem that some universities have, and that's just continuing to grow around entrepreneurship. And the people that tech transfer offices are bringing to the table to help their startups. And so my first instinct is that professors should be encouraged to go talk to other professors who have done it before, both the people that have succeeded and people that have failed, so that they know what they're getting into. And a lot of times I talk to professors as they're trying to balance this. A lot of them professors and grad students take on the CEO role early on, and they think they want it. And then they realize a couple of years in that it's not at all like running a lab. And that's something that I think professors may only respect hearing from other professors. And so I really think that the operational side of a company that all founders have to do, whether or not the CEO, is something they should be really thinking about early on. It's kind of one of the key things I think about.
I think that's great advice. A quick question: can a university protect itself from a recap?
Yeah, I saw that. I was trying to think of ways to do it. I think anti-dilution is that. Anti-dilution clauses are protections against recapitalizations, but for a finite period of time. Not a finite period of time, a finite amount of venture dollars raised. And so if you have a $20 million anti-dilution, which we haven't seen very often, and the company raises a round that is a down round or a recap after their Series A round or their seed round of $6 million, then you would have protection. That's the main way I can think of it. But I'm not as creative in licensing as Kirsten is. Any ideas, Kirsten?
Honestly, I'm not really sure. I think for them, a lot of it is protecting their intellectual property and making sure that the intellectual property is being properly developed, right? And so is this new structure going to help that intellectual property be out there and potentially having an impact on the world, or is this going to be an issue for it? So if it's a way forward, that's great. If it seems like a stall, that's going to be a problem. So yeah. All All right. A couple more questions. There are more and more of these venture studio types of VCs out there. Can you talk a little bit, or I don't know how much we've worked with these venture studio types of VCs about how much equity they should ask for, and or they're asked, or that typically goes along with that, or is there other kind of general things that people should know about working with venture studios, which is a newer type of entity, I think, out there.
Yeah, I think there's such a broad range, and when faculty and grad students talk to me about joining them, there are ones that are classic venture studios and incubators that a lot of the startup world knows about, but they're not necessarily relevant to the university spin-out world. And so there's like the Y Combinators of the world that are trying to kind of dip their toes into deep tech or life science. And they actually ask for a lot. And that's okay if the company is directly in line with where they can deliver value. And so I oftentimes suggest that, if you were a consumer-facing startup going to Y Combinator, it's almost like, take it for, as take it. But if you're a semiconductor startup going to Y Combinator, you don't get as much value. So I really encourage startups to think about what they're giving up when they go to them. For the venture studios that are starting to be created in some of the areas that are relevant to universities, there's a research tools incubator. There's a lot of life science incubators now. I think some of them are worth what they offer. The hard part is I've seen take safe notes with relatively low caps. And so you just have to be careful with what equity you're giving up and making sure it's worth it. So I encourage people to talk to former companies in those incubators or venture studios to figure out what value they got out of the studio itself.
Yeah, definitely. It's always good. It's just great to get that feedback. And we had another comment from our audience about founders who potentially ended up with very little from successful exits. And I just thought that was a good point to bring up, is that actually, that's what we're talking about throughout this presentation, is properly incentivizing people to be associated with the company, to be a part of it, and to be a part of its success. That's what equity is supposed to recognize. So I don't know if there's other comments that you wanted to make about that as well, but it is something else that you have to think about, those founders and how they're involved in the equity compensation they receive because of being founders of the company.
Yeah, I don't have I don't have much of an insight. It's definitely difficult. I often see, when founders don't end up making a life-changing event out of a company, an exit, it's frustrating. And oftentimes, I've never had this conversation with someone, but I think about it as like, what are the chances they would have made any money at all out of one company? It's, a lot of startup founders in the general ecosystem are putting many shots on goal. They failed their first one, they failed their second one, they go to their third one. And that's kind of the nature of the game. And I think faculty are so used to being successful in their industry that when they move into something and they fail, they get, they don't want to take another shot at it. And I think they just have to be willing to, if it's the money that they're excited about.
Well, this has been terrific. Nabil, Manny, thank you so much for your expertise, for doing all the research on this. Really appreciate it. And hopefully people enjoyed this, and we look forward to talking with all of you again soon. Have a terrific day. Thanks for joining us.
Thanks, everyone.
Thanks, everyone.